Good afternoon, good evening, and welcome to Traders Workshop for Tuesday, December 13th. And what a show we have today. I'm really excited for our next guest coming back on. But before we do that, we have a disclaimer to talk about. We have a new disclaimer. For those of you who love disclaimers, we have a new disclaimer. I'm going to read it right now. The information and opinions expressed in this program are those of a third party and not those of NinjaTrader LLC. Nothing contained herein should be viewed as NinjaTrader LLC providing legal, trading, investment, or tax advice, nor should it be viewed as an inducement to trade. The information and opinions are provided for informational purposes only and are not intended to be a replacement for securing individual professional tax, legal, investment, or accounting services. Responsibility and liability for the accuracy of and any use of the information and opinions given rests with the suppliers of the information and the user of the information. And with that, it is, I want to talk about our next guest. We've had our next guest on before. Back in August, we actually had two shows, but it's my pleasure to welcome back Larry Williams. Now, Larry Williams, 60th year in the futures market as a trader, educator, and author, with 11 trading books to your credit. Your groundbreaking work in seasonal analysis and the many technical analysis tools has have empowered traders all over the world. So it's again, my pleasure to welcome Larry Williams back to Traders Workshop. How you doing, Larry?
Great. Thanks very much for having me. It's always such a thrill and honor to do things like this. I never expected my life would end up doing this. So it's really a thrill to be able to do this.
Well, it's a thrill for us as well. And, we have on our bookend shows, Jim and I, and Jason, of course, we have a lot of viewers who very familiar with your work and follow your work and, reference those shows in August, reference other things you've said. Definitely, you do have an impact on traders that we see every day, pretty much.
Well, yeah, it's interesting to me that what started out as just a little career of me trading way back in the 60s has blossomed into this thing. I think partially I was just really early in the game. Nobody was doing this when I got in the business, if you will. And there's obviously a lot smarter and brighter people have come along since, but there's a few of us that were there at the get-go. And so people look up to us, or look at us at least, I guess. And it's always an honor. We're in third generation of some family, so it's kind of cool, like, to have stayed the task for quite a while.
That's great. That's great. So we were talking a little bit earlier. You had mentioned you were shoveling snow. You're part of the country that are getting this big storm. It seems like West Coast to the Midwest getting some snow.
Yeah, I'm in Red Lodge, Montana today, and we'll be leaving here as soon as the show is done to fly back to the Virgin Islands. There's no snow there, but I'm looking outside right now. It is still snowing. We probably got maybe 8-9 inches last night. So we got it plowed out and we're ready to rock and roll out of here once the show's done.
Oh, I'm sure they can get that plane off and out and get you on your way.
We hope, yes.
That's good. Well, let's start. I mean, I saw a little peek ahead of what we want to talk about, and there's a lot to talk about. So maybe if we can just let's get right into it.
Great, let's do. I mean, to me, there's a lot of ways of learning things. You can kind of learn by thinking about the future. Or in this case, what I'd like to talk about today is things that I learned from 2022, looking in the rearview mirror, if you will. I think you can learn by looking your errors, and I certainly made enough of them this year, as we probably all have. And so let's see if we can learn from that. And of course, I'll have my little thing that this is dangerous, that there is risk if you're going to be trading, especially if you're following my advice or any of the talking heads' advice. I think everybody knows this. If you're not, well, you should read these things. They're kind of interesting to read. They're a little boring, but they're intriguing to read. So this is what I was certain of in 2022. As the year began, I have old standby things that I really do believe work. The ones, the decennial pattern, the presidential pattern, long-term cycles, certainly the commitment trader report. And so that gave me certainty about some things in my approach to the market. And what I learned in the last 11 and a half months now is those things still work. And that to me is the most significant thing about my work and work of others, is that we haven't had to change any of the indicators. So we're really dealing with bedrock stuff here. So again, the year showed us those things still work. But I did some wrong things. So there's a lot of unlearning and relearning, and some things I should have known about 2022 that I'd like to talk about today. This was really a big one for me. To be or not to be, lovely air. That's a big moose, probably in Canada up by Glacier Park in Montana. And that's years ending in two. I mean, this is 2022, right? If you look at what happened in 1932 in stock prices, we had a low in July and then we continued rallying the rest of the year. And in 1942, a low in April, the year I was born, and a rally the rest of the year. And 1952, we made a low and then we continued rallying in a bull market. 1962, I remember this well. That's when I first got interested in the market, right about here when President Kennedy rolled back steel prices and the stock market crashed. And 1962, the market bottomed and went up. And 1972, the same thing, another big bull trend. And I knew that. In 1982, the same thing. I mean, I really knew that because I wrote a book in 1982, How to Prosper in the Coming Good Years, based on the thesis that usually years ending in two, we see significant stock market rallies. So this phenomena, the decennial pattern, I think is really valid. And I probably didn't emphasize that enough in my own view of the market this year. There's 1992, bringing it forward, another, look at that nice buy point in October, another bull market. 2002, the same thing again. And I wrote another book in 2002, The Right Stock at the Right Time, saying the same thing. We're going to have a market bottom in 2002. Initially, the book was called Blast Off, the start of the next bull market. But the publisher, since prices were down over here, wanted to publish a bearish book, and they did after the absolute week of the low. They published a really bearish book. It sold lots of copies. My bullish book didn't sell so many copies. But again, it shows this is something that we knew about. 2012, there's 2012, there's the middle of the year, another bull market. So years, there is a decennial pattern. Edgar Lawrence Smith wrote about this in a book that Warren Buffett has referred to, where he referenced Smith as being a bright guy. This is the red line you see is the average of all years ending in one, like 2001, 2011, 2021. So that was a cycle forecast for 2021, and pretty much what the market actually followed. The tops and bottoms came about as they usually do in years ending in ones. Now, years ending in two, this was a forecast for 2022. Down a little bit in July, then up, and then, whoa, look, this is where we are right here, right now. Well, I knew this. I published this in my 2022 forecast, and I didn't really give it, I didn't handle it correctly. I got really bullish in here. I got really bullish in here. So I did good here, still long with some really nice profits in here. But my only optimism or bullishness or whatever, I really didn't pay attention to this part of the move as much as I should have. So you can have a really clear view of the future and still you can wobble off the path a little bit.
And so this average of the last, let's say, 7 years that ended in two, it's an average price. So it really doesn't matter what those levels are, 52 versus 2012, because it's an average and you find a shape. I remember in August, you were calling for lows in October. And so, this is without going into it in, too much in October, this really is a great visual to show, maybe the average, the lows of the average are in July, but we were making lower lows at the point, I think, in August when we were talking about this. And so that informed your proclamation, your decision about October.
Yeah, I think the next chart, this is how it actually came out. So this is where the cyclical low should have been for years ending in two. All we did was retest the bottom and then came right back. So again, you have the visibility. Now, this is where I think this is important. Now, a lot of people say, oh, this is numerology. I was on Jim Cramer's Mad Money show and oh, this is just numerology. Not numerology. There is a 10-year pattern to stock market activity. And again, that was first written about by Edgar Lawrence Smith way back in the 1930s. So this has been around a long, long time, but we still have to use our own intelligence and our sense of it. But it gives me an idea of how the news is going to be. Like today, the news was very bullish in the market. Well, it should have been. That's what the forecast is saying. I'm going to talk more about that in just a moment. So the lesson learned here about forecasting, I think, is the markets are predictable. Some people say it is impossible to predict stock markets. I think I've just shown and have done for years in my annual forecast report. You can get a pretty good view of the future. But precision, occasionally get lucky, of course, and get a low day or a high or something, but precision's a problem. But as a general roadmap, yeah, we have the ability to see that. In my 2022 forecast report, I also showed the long-term cycle. And as you can see what that cycle was, down in the first part of the year, up, and then about where we are now. The next big move coming to the market is to the upside. And again, I probably didn't pay enough attention to this. I wasn't bearish enough earlier in the year. So it's a learning experience after 60 years of doing this. You still learn, your emotions still get involved in this. Now, here's where I was really wrong. In our 2022 forecast, this is my forecast for inflation, that inflation would peak and come down. Well, inflation maybe has started to roll over, but it certainly hasn't followed the red line, the forecast all the way down. So what did I do wrong? Maybe the forecast is correct in that we're starting to top out, but it certainly didn't come down as much as I thought it would. Here's the current inflation rate. By the way, if you want to follow inflation, the New York Fed has something called the UIG. This is really the best index to follow inflation with. And it has started to turn down a little bit, even more so as we saw in today's numbers, but certainly not like I thought it would happen. So what did I do wrong? Well, when I look at these, I say, I don't want to repeat my errors too many times. What's the lesson? And the lesson I learned here is that inflation numbers don't move as fast as stock market numbers do. So to turn around a rampant move in inflation takes a lot longer. Sure, the cycle shows it's going to roll over. You're going to cycle probably right, but the length of time that it takes for these moves to develop, that's where I was way wrong on it. And so I was wrong. And we're all going to be wrong at times. I've been wrong a lot in my life. We'll all have slumps in the market. And some people can't accept and deal with that. I have a friend right now who's been incredibly bearish in the market since almost the day of the low. And at some point, you have to realize you have an exit plan for being wrong. And that's another thing I learned this year. You've got to have an exit plan of when you say, yeah, I'm wrong. You can't be bullish or be bearish forever. At some point, you got to say, I got to stop doing this.
Larry, can I just really quick address one of your points in there, which I think is something Jim and I talk about, which is inflation. And I think, when you have multiple years of higher than normal inflation, that's not an additive effect, right? That's a multiple. I don't know if it's exponential, but it's multiple years of higher inflation over the course of the entire time that inflation has been rising. It's a little bit more than just adding those numbers. So it would take more in my thinking that it would take more to turn that around the longer we let inflation get, this bad, let's say.
I should have talked to you at the first of last year. I just didn't have that perspective. Oh, the cycles are going to go down. Oh, wait a minute. This is heavy economic data, as you pointed out. And so we may have cyclically topped here, but in terms of the time of it, totally wrong. Just wrong. So I didn't think about it enough. So a lot of this, you got to think. You got to really contemplate this stuff. So when we have slumps, what do athletes do when they have slumps? First of all, they relax. They pull themselves out of the game, and they'll go to get a coach. And I think as traders, I did that. I had some trades this year that weren't particularly good. I relaxed. I got out for a while. Just, you know what? I'm walking away. I'm on the wrong side of this thing. I'm not doing it right. Stop. Then got back into the game. Now, in my case, I did talk to a couple of friends of mine that are traders. You could call those coaches or friends. That probably helped. But if you get in a slump period, I think these are things to do. Just first of all, this is numbers. This is the stock market. This isn't the be all end all of the world. You got a wife, you got kids. Don't put too much emphasis on this. Stop, pull yourself out of the game, then maybe get somebody to help you with it.
And Larry, when you do that, just real quick, when you say you step away, are you stepping away for the rest of the day, the rest of the week, or until you see another opportunity? It depends obviously on maybe how wrong you are, or maybe how you have to reset. But and I shouldn't say how wrong, maybe how long the slump is. Do you have any thoughts about that?
Well, you always feel that you should step out probably for the rest of your life because you've been beat up. Nobody likes to be beat up, but I think I stopped trading for maybe a month. I'm going to talk a little bit more about that in a moment. And another thing that I was doing wrong, but yeah, not a day or two. No, well, maybe somebody can get their head together, wrapped up right again, and I can't. It takes me longer than that, so it takes some time. I think, at least it did for me. Okay, so wow, look where we are right now. Robert Kiyosaki, if I'm pronouncing that right, Rich Dad Poor Dad, 90% crash has begun. Only 10% of people survive. Ooh. Or Jimmy Rogers, we're in serious trouble, the worst recession in a century. My former roommate, Ray Dalio, the collapse has begun. Everybody's going to be wiped out next month. Well, this was 2 months ago, by the way, but you see all this stuff all the time. This was 61 days ago. We're on the brink of a zombie apocalypse. We have 25 days left. Well, like I said, 61 days ago. So there's a lot of fear mongering going on. I believe the economy is the biggest bubble in world history. Rich, God have mercy on us. Whoa, what is going on here? Oh my gosh. This is pandering. I've been in the published business, and I know you can make a heck of a lot more money publishing bearish newsletters than bullish newsletters. And as a friend of mine who published one for a long time said, they don't care if you're wrong because they believe the world's going to go to hell. And if you're wrong, they don't care because it's still going to happen. So, lesson learned, be careful of pandering. I see it this way. Being an investor, it's a big dark room we're in here. We can't see anything. And most traders are in that really pitch black dark room. That's why we're all nervous Nellies. You don't know what the future is going to be. You have no idea. You get rocket from one news story, another talking head. The Federal Reserve comes out. You have no sense of the overall trend of what's happening in the market. So it's really critical to me that you have a vision to follow. And of course, if the market isn't following your vision, then you realize you're wrong and you can adapt. But you have to have some type of a vision. And for the most part, buy and long-term investing, stocks usually go up. You want to maintain a very strong bullish bias. In the last, 100 years, the stock market has been down 2 or 3 consecutive years in a row twice. That's it. So one really big lesson I learned from my friend Nick Niederhofer is you want to be very careful about turning bearish, and all the Cassandras, the purveyors of doom, and they're going to be wrong. So there's another wealth killer. Look at this guy, 100% guaranteed strategy. Take $2,000 to $10,000. Wow. Now, if the guy was really making that much money, you think maybe he'd buy better fitting clothes than what he's wearing. I don't know. I wonder about that. Oh, that was Bitcoin too. Yeah, that was a great thing, wasn't it? Or get rich trading. Another wealth killer. This guy's made some money. Those arm sleeves, I asked how much. That's about $6,000. So this guy was probably making some money getting rich trading one way or another. Scalping 8 hours, 179 profit. Want the easy way to do this? These are what I call wealth killers. You see all. I even go, oh, what is this guy doing? He's got something new. No, it's the same old hustle. Lesson relearned for me in 2022. There is no easy way to the top. It's still going to be difficult to get up there. It's a long haul, and you're going to slip and slide, and it's going to be cold, and the wind's going to blow. There's just no easy way. This is work, and you don't get carried away by these people or by the purveyor, the pessimism. You have to march to your own music. So lesson learned again, beware fearmongers and vendors. And they always get us.
And Larry, with those people that you highlighted, I don't know who they are, but they have access to technology, which we haven't had before. They have access to tools that allow them to create really snazzy, screens, and if they yell at you instead of talk to you, well, maybe there's something to. No, absolutely not. There's nothing to it. You're exactly right. I think we try to steer people away from these type of promises that you might see when you're tooling around on different social media sites or on the internet in general.
Well, the only reason people trade, when you think about it, is because we're greedy. So when we see things like that, we fall for it. We're
Right.
really susceptible, it's just in our blood. So you trust and verify, and be careful what you read. I mean, this was Forbes magazine. Elizabeth Holmes, remember her, the Theranos fiasco, and oh, the Forbes for yeah, remember this guy? He's been very popular right now, hasn't he? Took everybody's money, billions of dollars, gave billions of dollars to political people, and really made his way. But he couldn't afford a haircut in this case, and he apparently couldn't afford pants. He always wore shorts. So just be careful of what you read. It doesn't matter if it's in Forbes or if it's something I write or anything. You just got to be a little careful. There's money involved in this business. My experience is wherever there's money involved, somebody's there is going to try to snooker you and me one way or another. So I've had questions about my 2023 forecast. It's about done. We'll probably release it maybe just after Christmas. If you want more information on that, just go to our website, ireadytrade.com, go to our email list, and then we'll let you know when it's ready. But I have just about completed the 2023 forecast. Okay, let's get back to the ABCs of trading. Tom, what are the ABCs of trading? They are always be cautious. Yeah, when I was a Boy Scout, we had the ABCs of scouting. It was always be considerate. And that's a great thing to live by. And in trading, you just change it, always be cautious of the markets, of yourself. And the basic rule, don't bet big. You have to control your losses. Especially when you get successful, you think, wow, I'm the master of this thing. I got it all figured out. You don't. And that's when you got to get into trouble. You are not the master of this. It's not the market, though. I think it's really all in our head. It's you have to have data, better data than the next guy, but you have to be more clear in your own thinking than the next guy. So it's what information you possess, what tools you possess, and your own personal clarity, how well you can respond. I ran across this Weber's law. This is really interesting. Small increments are not detectable on large loads. What do they mean by that? If you're wearing, say, a backpack on your back that weighs 5 pounds, and I put in another 5 pounds, you're going to notice it. You feel a 5 pound. But if we have a larger load, let's say I have a backpack on you of 65 pounds, and I add 5 pounds to it, people can't detect that when they actually test this. Another way of looking at if somebody's given a prison sentence of 35 years, a long time being in a cage, and they say it's 35 years and 6 months, 6 months doesn't seem like much, does it? So right. The larger the load, the less you can detect the incremental add, whether it's time or whether it's a weight. And this is actually a provable theorem. You can Google it yourself if you want to. So I thought about that a lot, and that's Weber's law. So as you add weight, you can feel it, but the more weight each line is, say, 5 pounds added, you can't tell at all if there's been any. You have a 250-pound pack on, you can't tell if they've added a pound or 2 pounds. You just don't notice it. That's Weber's law, and here is Williams' law. Rational thinking diminishes to the larger your position. In other words, here's rational thinking, but the more contracts you have, the more irrational you become, the more emotional you become. So the reason you get really emotional in the market is really the reverse of Weber's law. It's what we'll call Williams' law. You're rational if you're 1 or 2 contracts or not trading. If you're not trading, the stock market doesn't affect you at all. If you get down here with 1,000 contracts on, you get very irrational. You become emotional because the size of the position is too much for your emotions. So you really need to think about that if you find you're becoming emotional and not really rational in your thinking, probably because your position is too big for your emotions. That's really the basics of money management. money management isn't about managing money. It's really about managing your emotions. And the larger the load, the more emotional or the more irrational, illogical your trading will be.
And Larry, this is the first I'm seeing it? I saw it when I had a sneak preview of your deck. Is this the first time we're hearing about this, or have you published this before? I love it. I love it.
No, never. This I just ran across Weber's Law a couple of weeks ago, and I thought, wow, that's really interesting. They did actually a lot of tests with this, and people can't tell at a low level. You can tell you've added a pound or 5 pounds, but at a high level, and then I thought, well, how about time? Time is the same thing, right? If I'm going to be in a trade for 3 years and 2 days, it doesn't seem like much. But if I'm in a day trade for 2 days, whoa, it's an eternity. Or the idea of a prison sentence or whatever. Yeah. So I thought, well, the reverse of that is in the markets. The bigger your position is, well, the more contracts you have will be the same thing. If you're in position, you're 10 positions instead of one, yeah, the more irrational you're going to be. The load becomes much heavier. If I load, say, one contract here versus one down here, you just become a lot more irrational. So that's the first time. This is something I've been thinking about a little bit. I hope that it registers with people. I think there's merit to it.
I think so, and I think every tick, whether you have, is going to be different, right? Every tick move in your direction or against you, obviously going to be more impactful when you have 1,000 contracts versus one or two, right? And that kind of is, wow, that's a huge thing.
Yeah, when I was a big bond trader, each tick was worth $62,000, and as a percentage of the assets I was trading, wasn't that much. But to me, $62,000, especially back in the 1980s, that's a lot of money from where I came from. So just the size of the money will influence you, and clearly because you're making money and losing money every day in your positions, it really affects your emotions. So you really need to understand that if you're a very emotionally, you're influenced easily by emotions, probably not for you. My son did a psychiatrist at Johns Hopkins and did a study of really the great traders, some really wildly successful traders. And in their personality profile, he found they were not emotional people. And I think that's probably one reason why they're so successful. They could put on a lot of weight, and their rationality would stay up here. It wouldn't decline like this. Yeah, if you're a highly emotional person, everything makes you emotional. Probably not what you want to be doing. Okay, so let's look at some other things that have worked, and I'm going to go over these with you. Seasonality has worked this year quite well. Cycles, commitment to trader index, of course, what large commercials are doing. Trend is always important. Chart formations, I'm going to show you one of those in a moment. Sentiment and fundamentals. These things, I think, guys and gals, are really consistent. They worked for me 50 years ago. They'll work 50 years in the future. This is bedrock stuff here. You might want to make note of that. There's probably other bedrock stuff. I just haven't found it. But in my world, that's bedrock. So here's the megaphone pattern. I've explained this for years. The market runs up, comes down, makes a higher high, makes a lower low, makes a higher high. In the Ultimate Chart book, Edwards and McGee, they call that a broadening top. And a broadening bottom would be you come down, you rally, you make a new low, make a new high, make a new low. So it's like a megaphone. I call that, this is a megaphone, right? You can shout out market top or shout out market bottom. That's the pattern. Well, this year we saw there's a megaphone right there. Look at that. Up, down, up, lower, higher. There's a megaphone pattern right at the market top. Then we had another one, a pretty good rally in the market. We went down, up, down, up, down. So there's our megaphone, higher highs, lower lows, shouting out for market bottom. And we had this market bottom, huge rally in the market. And we had another one at the recent rolls in October. We had down, up, down, up, down. There's the megaphone, higher highs, lower lows in the market. That's a megaphone pattern. So chart formations can be helpful. This is one I've used. Wells Wilder wrote about it. Edwards and McGee wrote about it. I've written about it. It's a really nice pattern. The problem is it doesn't always occur. But when it does, you really want to pay attention to the market. Another formation that always intrigued me is what I call fake breakouts. Here's the market breaks below a low, and it's actually a very good buy. And technicians will usually be selling there. Here it breaks above a high, and it's not a good place to sell. Here it breaks above a high and doesn't. How about here? We come down, break to a new high, great place to sell. Break to a new high over here, whoop, market comes down. Break to a new low, we're in the area of a buy. Break to a new high right here, the market comes down. So can we do something with these breakouts? Yeah, we can. My experience in trading is if we get a breakout like this, if we immediately reverse it within 2 days, 3 days at the most, it's a fake breakout. Like down here, we came down, broke out, we immediately reverse it within 3 days, the opposite move begins. Here we broke to a new high and we immediately reverse it actually in 1 or 2 days. So if you see a breakout to the upside or the downside, it might be valid. But watch it. If it's immediately reversed, it's most likely a fake breakout. I also like cycles, of course. Here's a simple way of measuring cycles. I measure from this peak to this peak, and that's this line extended from the low in between for this market low. So again, that's peak to peak, extended from low in between. Peak to peak, extended from low in between. Peak to peak, extended from low in between. And that's how you can do some really basic, simple cycle work. And if you want to measure very short term, low to low right here, add that to the peak, you got your sell point coming in there. You can do low to low, add to the high, and there's your point. So, and I stumbled onto this in 1966, I think, something like that. When I first started really attracted in cycles, joined the Society for Investigation of Recurring Events, where I met W. DeGan's son, Art Merrill, a lot of interesting people. But it's just really, this is a cycle from here to here, top to top, take that distance, add it to the low in between, and that's where the next low should become. Or you would take, say, this low to this low, that distance added to the high in between, and that's where you should get your next high. It's a really simple technique, pretty effective. It's free. You can do that real easy. I also still think valuation matters. Here's my valuation measure in NinjaTrader. We're looking at Apple. Apple can be overvalued and it comes down, it gets undervalued, and here it rallies. So I really like to see stocks or commodities when they're undervalued. And I think we can measure valuation in individual markets. And so valuation really held up really well this year. Here's valuation in Meta. Overvalued. We were undervalued here. You see, undervaluation is a nice setup tool. So there's another thing that, again, we learned this year, valuation models really work. Still matters. Now we're looking at crude oil. Crude oil is overvalued, undervalued, the best times of the year to buy crude oil. Overvalued, good time to sell crude oil.
My question about this, you mentioned it's not a timing indication as far as your indicator at the bottom, but it's more of, to me, when I look at these type of indicators, I look at more of like a state-based indicator where we have somewhat of possibly an oversold or overbought situation, and it's not necessarily that we want to do something when it becomes that, but it's more of getting out of that situation, right? So correct me if I'm wrong, because I'm not as familiar with your indicator.
No, that's absolutely right. I'm going to try to find some examples. It's not an overbought, oversold indicator. Try to find some places where we really see that. And most overbought, oversold indicators will be, well, yeah, we're overvalued right here. Well, price is actually lower here than here. Most any oscillator was not going to be overbought at that point. And we're using weekly charts here. So the market came up, but not very much. But wow, we're as overbought as we were back here, or I'm sorry, overvalued. So it's not overbought, oversold. It's a relationship of meta to interest rates, or the relationship of a commodity to gold. And what I found is they get out of whack with each other. If stocks get way above the relationship to interest rates, and they're almost all these stocks are in debt, they're overvalued. It just says somewhere in here, I want to be looking for a sell signal. The ideal ones are when you're in a downtrend and you become overvalued. Look at that. Nothing's going to show overbought in here, right here. The market's still a big downtrend
Right.
and it's overvalued. Same thing over here, and it's overvalued. But it's not a timing tool. It's like, oh yeah, we better, if I'm in this stock and I want to be long or short, like I said, I want you to come out of that dark room where it's so pitch black and you can't see anything. Now go, yeah, I see what's happening. We're overvalued here, we're undervalued here. Okay, these are the lessons from my mind I'd like to kind of share with you. I believe my trades will be losing trades, by the way. When I put them on, my belief is not a positive one, a Tony Robbins, dare to be great, whatever. I believe the trade's going to lose, which means I protect myself. Because if I'm afraid of my trade, that's really the great mental attitude to have. If I'm not afraid of my trade, and I've been that way before, oh my gosh, too big of a position. I move my stops. I do everything wrong because I'm too confident. So I don't believe my trade's going to work out. I don't think they exist. People always say, oh, they went for my stops. Let me tell you, there's no they. My distinct memories having a friend of mine who was a specialist in the New York Stock Exchange calling me up and asking me what they were doing down there today. I was going to ask him, but he didn't know. And he was making the book on the stock. I've had bankers from Zurich call me wanting to pay me to tell them what the price of gold's doing. And I thought those bankers in Zurich would know. There's no they. We like to say they because then it absconds us from responsibility. There's no they. It's you. And it's really stupid to never give up. I mean, I love the motto, never give up. Yeah, I understand that. But, if you're doing the wrong thing, you better give up. If you're an alcoholic, you better give up. If you're on the wrong side of the road, you better give up. If you're losing money in the market, you better give up and change. You've got to make some changes. So people will get a view in the market and never give up. Well, you have to be willing to give up. It's hard to admit you're wrong. It's really hard, especially in the market. But it's going to pay off a lot better to admit that you're wrong. I think this is one of my big problems this year. I tried too hard. I was certain I was going to set the world on fire, do such as I had my goals, my affirmations, all that stuff, Tom, everybody does it the first of the year, right? I tried too hard. So don't try too hard. I used to say, if you really want to lose weight for your New Year's resolutions, make a resolution to gain weight because New Year's resolutions never work out. And I think it's kind of the same thing with, I'm going to make a lot of money. No, just monitor your trades, work on your trades as they come along. Affirmations, goals, and visualization, I don't think they work well for traders. If the focus is on performance, I'm going to follow my strategy. I'm not going to deviate. I'm not going to take too big of positions, whatever. That's your goal. Your goal in visualization isn't how much money I'm going to make. If the visualization is, can I walk the path? Will I walk the path and stay on it? That's what I think will be the most successful for you. And write it down, man. I've learned my lessons. If you write it down, it's like in the old school days, right? I will learn my lesson. Whatever your lesson is, if you've learned a little bit from this presentation or on your own, write it down, commit it to your memory. Oh, I love this, Warren Buffett. If you don't find a way to make money while you sleep, you will work until you die. I think day traders should put that on the wall because day trading is really a tough business. And Warren Buffett's not a day trader, and he's a multi-billionaire. He never day traded. So you might want to think about that. But if you're going to dance with the devil, day trading, we have a really cool indicator, NinjaTrader. That black line you see is the S&P E-minis, and the red line is the cycle forecast. It's known in advance. It's known 60 bars in advance. So this low, when we should rally, we knew that way back here. That we should decline in this time period, we knew that way back here. So this is extended in the future. As you can see, the line goes in the future. You can see what should happen. So if you want some direction, we knew that there should be a low in the market. It was, like you can see in here, quite a few bars in advance, right? The market should continue moving higher.
Larry, let's your cursor isn't showing up on the screen.
Oh,
so,
okay.
Maybe we'll just take a quick pause to see what that is. I don't know if Mission Control can help, but we do have a question, and maybe while we're figuring that out, You mentioned earlier finding a coach, right? If you're in a slump, find a coach. And for a lot of our viewers, they're new traders. Uh, Question is, how do you find a coach? You're a new trader, and how do you find a coach with the best interests of the trader in mind without wasting time or money? And I know that's kind of a broad question, but what's your, because you do have a lot of new traders and they want to kind of find out how that can help them.
Well, I'm not one. I'm not trained in it. So I can teach about the markets, but I don't really know how to mentor people. I think that takes a special skill, but there's like thousands of people saying they will mentor you. The only one I found is really good at it, because we've sent people to him and I've got good replies back, is my friend Jake Bernstein, who's a psychologist by training and by education. So maybe that's why. But there are a lot of people out there who will claim that they're really mentors and good coaches or whatever. And there probably are, but the only one I have personal experience with is my friend Jake.
Okay, great. We're just going to take a quick break and we'll see if we can get this issue resolved.
Okay,
we're
we should
back.
have the cursor showing.
Yes, we do. Yes, this is great.
So you see, this indicator will forecast in the future what the market should do, or the general path that it will take. And that just gives us visibility of what should happen. This is bonds on a 50-minute bar chart. So the indicator is in NinjaTrader. What you have to do is find out what settings is working best for 15 minutes, hourly, 5 minutes, whatever. Then when you find that fit, it's been a really good indicator to help in that dance with the devil. But again, I think the big money is not in day trading. But if you are going to be a day trader, another point is look at all the large range bars. That's where day traders make their money. They all close, almost always close on their extreme. Big range bars close on the high, big range bars close on the low. So if you get a successful day trade on, don't get out in a hurry. Hold on. After all, the trend is your friend. You want to hold on to that as long as you can. Large ranges, big trading opportunities for day traders. Don't take little profits, because you don't know where the high of this day is going to be, but the close will be very close to the high of the day. So hold to the close. Old stuff still works. That's really important to understand that we can look at, here's an index we use called pinch punch. When it gets above 40, the market set up for a buy signal, seasonal pattern, the markets start to rally. So there's a lot of old stuff that still works. People are always looking for a new indicator. I saw something today, but a new indicator. Well, let's test this for 30 or 40 years before we know. Oh, it was computer simulation. Means nothing. So there's a lot of really good old stuff out there that still works. I think the driving force in 2023 is going to be all about the Fed. Rates will drive stock prices, and it's going to be based on inflation, as we saw in today's market action. So if you're looking for news as a helpful thing, those are going to be the big news topics: inflation and interest rates. In terms of what I think is going to happen in the market, this is the forecast we showed quite a while ago. So the market had a 77% chance of moving from here up to here, pull back a little bit, and then go to the upside. That was a forecast made in September. They had no idea what would happen. This is how it actually turned out. Here it is, rally back, and now, you saw what happened today. So we're in this phase. We have an 80% probability of rallying now into the first part of the year. So this is how it's coming out, I think, for those who follow this forecast. This is the path that we're still on. My 2023 forecast report, again, about 12/28. We're going to release it. Go to ireallytrade.com. Join our mailing list. We'll let you know. Careful of the yield curve. This has been a big subject this year. The yield curve is bearish. Well, yeah, it's been bearish lots of times. Here's the yield curve. That's the black line on your chart. Turns negative, and look at stock price. Wow, went way up. Here's the yield curve. Turns negative, stock go higher. Turned negative, stock came down. Turned negative here, and eventually stocks came down. So the yield curve is an indicator, but I wouldn't bet the farm on the yield curve. It can be very bearish, and sometimes it doesn't seem to mean anything. So we've gone a little bit over time, I think, Tom. So I better stop talking and wish all of you for a golden 2023. We're going to have a great year coming up in the market. And thanks again for having me and those who watched us today. I really appreciate your support over the years and watching my research as it's developed. Thanks very much, everybody.
Larry, thank you so much for coming back on and sharing with us your information. And I know you're probably trying to get out to a warmer climate, and that's sunny days ahead. But thank you again, and look forward to talking with you again in 2023.
I look forward to that. Thanks for everything, Tom. Really appreciate you guys very much. Thank you.
Thanks, and have a great holidays, Larry, with you and your family, and safe travels. And we'll do this again for all of those who joining us. Thanks again. Bars closing 3:15 today. But again, thanks for coming, and have a great rest of the trading day.